Hello, everyone. This is Zaid Hanna with the Hanna Group. And today's topic, we are going to cover what mortgage program is right for me. So, we help a lot of buyers. And the number one question is how much can I afford? How much money can I actually put down? So, we're going to cover these three topics. Step number one is identifying the down payment. Step number two, identifying the monthly payment. And step number three is identifying the terms of the loan. So, we start with identifying the down payment. Now, there's this myth out there of you have to have 20% down, so mortgage insurance is completely eliminated. Well, that's not true because you can actually do 10% down with no mortgage insurance. You could do 15% down. Of course, different institutions offer you different programs. So let's start with the top. You have 3.5%, that's called an FHA loan, where you will have mortgage insurance. Then you have 5% down payment with certain brokers that you can actually go and they'll offer you 5% down, 95% loan amount. Now, the increased interest rate sometimes covers the mortgage insurance. In some instances, you will have mortgage insurance associated with that. Then you have 10% down payment. Now, some of the bigger banks, they will offer you a 10% down, 90% loan program. Oftentimes, it's 10% down with 89.9% loan, and mortgage insurance is completely waived. Now, of course, the interest rate is slightly higher than the best rate available in that market at that time. So then we have 15% down, where you do 15% down and 85% loan. With some institutions, you'll actually get one of the best rates. There are about two banks that will offer that. And of course, your traditional 20% down with 80% loan amount, that will get you the best rate possible. Of course, if you are an A paper borrower, meaning your FICO score is great, your debt to income ratio is great, and your down payment is available in terms of the 20% down. And of course, you can go anything higher than 20% is great and gravy. Banks love that. So you can do 50% down and 50% loan. Now, I want to go back to the 10% down. You can actually do 80, 10, 10. Credit unions are big on that, where you can put 10% down, they'll give you an 80% loan, and they'll give you a 10% second loan. Now, the 10% second loan is the HELOC type, home equity line of credit type. So what that is let's just say the 80% loan is at 3.5% interest rate. The 10% on the second loan is 5.5. Depends on where the Fed rate is at. So that's some of the programs that you could actually use as a down payment, where you could identify to say what makes sense for me. So every family is different. It depends on your cash flow, where some folks are cash flow heavy, but they haven't saved enough money. 10% is great for you. Where the cash flow is not there, it's tight, but they have the down payment. So I'd say let's go ahead and get your monthly payments as low as possible. So that way the monthly payment, you're not house poor. You can actually do other things. You can travel and so on and so forth. Now, identifying the monthly payment. So we refer to it as PI, principal and interest. We won't cover TI, which is tax and insurance, but overall the banks will look at that. So they will look at your income and they'll identify you could borrow up to 43 to 45% of your income before taxes towards debt. That's credit card debt, that's car debt, student loans, any debt you have, including mortgage payments. So let's just say you don't have any debt and you make, say, $10,000 a month before taxes, right? So you could allocate $4,300 towards that mortgage payments. So now, in terms of identifying, based on what the rate is going today in the market, for every $200,000 loan amount, your mortgage payment will be $1,000. So that's, by the way, with tax and insurance. So every 200,000 is $1,000 a month. $1,000,000, $5,000 a month, and so on and so forth. So as you're doing the math to identify, most of the calculators out there, it doesn't matter which program you use, it will tell you about the same thing. Based on today's interest rate, principal, and interest, that will identify that. So monthly payment is very important when you are making a decision to say don't overstretch yourself by trying to get a single family resident when your budget and your income and your down payment can really afford a condo or a townhouse. If you're starting and this is a first time home buyer, if I would share my story with you, I would tell you start with something smaller, build equity, and move it on to the next house, whether it's a home or a larger townhouse in a different area. So don't overstretch yourself right away. Start small so you're comfortable in making those moves later, whether it be 2, 4, 5, or 7 years from that point, because our needs will change every 7 years. So we can actually buy a property that matches those needs. So the last step is identifying the terms of the loans. Now you have a 30-year fixed. Everybody talks about that, and it's actually mostly used. Now, the new generation, I could refer to them as the millennials, they are moving statistically every 5 to 7 years. So I get the question asked, well, Zaid, I am not going to stay in my home past 5 years. I'm getting a 2-bedroom condo. I'm not married. I'm dating my maybe future wife. We don't have any kids yet. A 2-bedroom condo near my job is perfect. Well, great. So then you don't need to get a 30-year fixed, because a 30-year fixed, let's hypothetically say at today's rate is 3.5, a 10-year ARM or 7 ARM, that's adjustable rate mortgage, will be maybe 2.75 or maybe even 3%, about a half a point to 0.75% swing between an ARM product to a 30-year fixed. If you are not going to keep your condo, why pay the increased interest rate? So this is where you got to sit down with your mortgage consultant, and of course we could refer you to many. We have a lot of relationships in this market. I am not a lender. I'm not a licensed lender. I'm a licensed real estate agent and broker associate with Intero. But we've seen this so many times where we've actually held our client's hand in this consultation at first to say, let's see what makes sense for you. And this is the direction in which we put you. So that way you can go and talk to these 2, 3 lenders to say, hey, based on what you've told us, they are going to be the best for you in terms of interest rates, programs, and the length of escrow in which we can actually close that transaction when we find you a home. So that's typically the 3 questions: is identifying the down payment, identifying the monthly payment, and which program for me to go in. And at the end of the day, I want you to know that no matter what program you go into, you can always accelerate your monthly payments. Meaning, if you get a 30-year fixed and you want to stay in that home for the next 20 or 30 years, you can actually pay down your mortgage by sending extra payments, and I do that all the time. So if you're cash flow heavy, meaning if your income exceeds what your expenses are and you don't know what to do with it, just make an extra payment or 2 extra payments a year. It'll shave off maybe up to 4 or 5 years worth of payments later on your mortgage. If you have any questions or any concerns, or you'd like to know more specific products about the loans, feel free to reach out to me, 408-515-1613. Bye-bye for now.